One of the most well-documented edges in financial markets is also one of the most counterintuitive. Stocks that have been the strongest performers over the past 3 to 12 months tend to continue outperforming over the next 3 to 12 months. This is called price momentum. It has been observed across markets, across decades, and across asset classes. It is not an anomaly. It is a persistent behavioral pattern driven by the slow diffusion of information and the underreaction of investors to new fundamental developments. The corollary is equally true and equally uncomfortable. The weakest performers tend to continue underperforming. Momentum is not about chasing. It is about identifying where the sustained buying pressure is concentrated and aligning with it rather than fighting it. AI makes that identification fast and systematic. Let me show you how. Understanding why momentum works makes you better at using it. When a company's fundamentals improve, a new product succeeds, margins expand, a market share shift occurs. The market does not instantly reprice the stock to fair value. It takes time. Analysts are slow to revise estimates. Institutions need months to build full positions without moving the market against themselves. Retail investors wait for confirmation. The result is a gradual repricing process that can last quarters or years. A stock that has already moved 40% in the past 6 months is in the middle of that repricing, not at the end of it. The move is telling you something real about the fundamental story, and the story is probably not fully priced in yet. Momentum also has a psychological component. Stocks making new highs attract attention. Media coverage increases. Analysts upgrade. Institutions that missed the move start initiating positions. The buying feeds itself until the fundamental story is either fully priced or clearly deteriorating. AI is built to identify the stocks where this process is most advanced and most consistent. Prompt 1 identifies which stocks are leading the market, not just going up, but outperforming on a relative basis. Absolute performance is misleading in a bull market. When everything is rising, the question is which stocks are rising the most. When the market falls, the question is which stocks are falling the least. Relative strength separates signal from market environment. Use this prompt with a list of stocks you want to compare, your watch list, an index, or a sector. Calculate the relative strength of each stock in this list over the past 3 months, 6 months, and 12 months, using percentage price change. Rank them from strongest to weakest for each period. Then identify which stocks appear in the top quartile across all 3 periods. These are the consistent leaders. For each consistent leader, tell me their current price relative to their 52-week high, their average daily volume over the past month relative to their 12-month average, and whether their relative strength rank has been improving, stable, or deteriorating over the past 30 days. Stocks in the top quartile across multiple timeframes are the ones with sustained institutional buying behind them. One strong month can be a news spike. Sustained outperformance across 3 periods reflects a structural advantage. The relative strength ranking gives you a sorted list. Here's what to do with it. Consistency over magnitude. A stock that was 15th out of 50 in 3-month performance, 12th in 6-month, and 10th in 12-month is more interesting than one that was 2nd over 3 months, but 45th over 12 months. Consistent leadership across all 3 periods means the buying has been steady, not episodic. Proximity to the 52-week high. Stocks making new 52-week highs or sitting within 5 to 10% of them are in the strongest technical position. There is no overhead supply of trapped buyers waiting to sell. Counterintuitively, these are often the lowest risk entry points from a momentum perspective. Improving rank. A stock whose relative strength rank has moved from 30th to 15th to 8th over the past 3 months is accelerating. That acceleration is often the early signal before a major breakout move. AI will surface this trend in the ranking data. Prompt 2 measures the speed of the move, not just the direction. Rate of change, ROC, is one of the simplest momentum indicators. It calculates the percentage change between the current price and the price end periods ago. A 20-day ROC tells you how much the stock has moved in the past 20 trading days. It is a raw measure of velocity. The value of ROC is in comparison across stocks, across time periods, and relative to the stock's own history. Use this prompt. Calculate the 20-day, 60-day, and 120-day rate of change for this stock and compare each to the equivalent ROC for the S&P 500 over the same periods. Tell me whether the stock is outpacing the index on each time frame and by how much. Then calculate the stock's own historical ROC percentile. Where does the current 60-day ROC rank relative to all 60-day ROC readings over the past 3 years? Finally, identify whether the 20-day ROC is accelerating or decelerating relative to the 60-day ROC, which would indicate whether near-term momentum is strengthening or fading. A stock with a 60-day ROC in the 90th percentile of its own history is moving faster than it has 90% of the time in the past 3 years. That is statistically unusual. An unusual upward velocity in a stock with strong fundamentals is a momentum signal worth taking seriously. Rate of change analysis produces 3 usable data points. Index relative performance. A stock outpacing the S&P 500 by 15 percentage points on a 60-day basis is attracting capital that is actively moving away from the index. That capital has a reason to be there. It is not random. The relative outperformance tells you the stock is in demand. Historical percentile. Context matters enormously. A 20-day ROC of 12% might be normal for a biotech stock, but extraordinary for a utility. The percentile comparison strips out sector-specific volatility and tells you how exceptional the current move is relative to this stock's own behavior. Acceleration versus deceleration. When 20-day ROC is significantly above 60-day ROC, short-term momentum is accelerating. That acceleration often precedes a breakout. When 20-day ROC drops below 60-day ROC, the near-term velocity is fading even if the longer-term trend is still positive. Deceleration is an early warning to tighten stops or reduce position size. Prompt 3 tests whether momentum in this specific stock has historically been durable. Not all momentum is equal. Some stocks spike sharply and then mean revert quickly. Their momentum is fast-moving but not persistent. Others grind steadily higher for months or years. Their momentum is slow but extremely durable. Knowing which type you are dealing with changes how you manage the position. Use this prompt. Analyze the historical momentum persistence for this stock. Look at the past 5 years and identify every period where the stock was up more than 15% over a 3-month period. For each such period, how long did the momentum continue before a 10% drawdown occurred? What was the average peak gain from the start of the momentum period to the eventual top? And how often did a 15% 3-month gain lead to a continuation of at least another 10% gain before a correction? Also, compare the stock's beta to its sector beta to assess whether its momentum behavior is idiosyncratic or tied to market moves. Momentum persistence, data shapes, position management, duration. If strong momentum periods in this stock have historically lasted 4 to 6 months before a meaningful correction. You have a rough time frame for the trade. That does not mean you sell at month 5 regardless. It means you become progressively more alert to deterioration signals as the move ages. Average peak gain. If every major momentum move in this stock has produced an average of 45% from signal to peak, you have a rough magnitude reference. You are not targeting exactly 45%, but if you are already up 40% on an open position, the historical distribution suggests you may be near the end of the move. Idiosyncratic versus market-driven. A stock with a beta of 0.6, whose momentum episodes are powerful and consistent, is generating that momentum from company-specific factors, not because the market is dragging it higher. That is higher quality momentum. It will persist through market volatility because the underlying driver is not dependent on a rising market. The bonus move puts individual stock momentum in sector context. Individual stock momentum does not exist in a vacuum. The most powerful momentum setups are ones where the stock is leading within a sector that is itself leading the market. 2 layers of momentum, sector and stock, is materially better than a strong stock in a weak sector. Use this prompt. Rank the following sectors by their 3-month and 6-month relative performance versus the S&P 500. Technology, healthcare, financials, energy, consumer discretionary, consumer staples, industrials, materials, utilities, real estate, communication services. Identify which sectors are currently in the top 2 quartiles of relative performance. Then, for the stock I have been analyzing, identify which sector it belongs to and assess whether the stock is outperforming or underperforming its own sector peers over the same periods. Give me a summary. Is this a leading stock in a leading sector, a leading stock in a lagging sector, or something else? Leading stock in a leading sector is the highest conviction momentum setup. The macro tailwind of institutional capital rotating into the sector amplifies the stock level momentum. Lagging sector with a strong stock can still work, but you are fighting a headwind that makes the trade harder. Momentum is a documented edge. The question is not whether it works. The academic literature on that is extensive. The question is whether you are using it systematically or randomly. Prompt 1. Relative strength ranking. Identify the consistent leaders across multiple timeframes within your universe. The stocks in the top quartile everywhere, not just over one period. Prompt 2. Rate of change. Measure velocity relative to the index and relative to the stock's own history. Identify whether near-term momentum is accelerating or decelerating. Prompt 3. Momentum persistence. Understand the historical life cycle of momentum moves in this specific stock, how long they last, how large they get, and how often they continue from the point you would enter. Bonus, sector context. Confirm you are buying the leading stock in a leading sector where 2 layers of tailwind support the trade. The best momentum trades feel uncomfortable at entry because the stock already looks extended. That discomfort is often what creates the opportunity. Next episode, Fibonacci, the retracement tool most traders misuse and the extension tool most traders ignore. See you Monday.